So are you looking to get a mortgage, but all these different terms that people are throwing out there are just straight up complicated? But they don't have to be. That's why I made today's video, to show you exactly what these terms mean and how they pertain to your mortgage. Thanks again for tuning in, guys. It's Tom here from Off Mortgages. As always, please feel free to like the video down below, as well as subscribe to the channel and hit that bell icon so you don't miss videos like this in the future. So if you're anything like me when I was getting my first mortgage, when all these bank reps and mortgage brokers are throwing out these terms like LTV, amortization, or mortgage insurance, all these words are confusing the heck out of you. Well, you're not alone. I too was once there as well, and I know how frustrating it can be to not understand what these words mean. Well, this video is going to break down all of the general terms that you need to know when it comes to getting a mortgage. So I promise you, by the end of this video, you will have learned something new and you will understand all the mortgage basics. Okay, so let's first start off by explaining what a mortgage is. So to put it in its most basic form, a mortgage is simply a loan to purchase a home. And the reason why people get a mortgage is because they simply don't have hundreds of thousands of dollars laying around to purchase that home. So to determine the mortgage amount, you simply take the purchase price and subtract the down payment, which will result in the mortgage amount. Okay, so now let's move on to amortization. Amortization simply means the amount of time it takes you to pay off your mortgage. Now, as a first-time home buyer, if you're purchasing your first home, that amortization is likely going to be 25 years or a 30-year amortization. Now, if you have less than a 20% down payment, you are forced to either take a 25-year amortization or less. You cannot stretch that amortization any further than a 25-year amortization. Now, if you have 20% down or more, then you can go with the 30-year amortization. There's many pros and cons when it comes to a 25 versus a 30-year amortization. However, I'm not going to go into too much detail about this. That's for a later video. Okay, so now that we have amortization figured out, let's move on to term. Your mortgage term can be thought of as simply securing a contract with the lender. So for example, if you lock into a 5-year term, you are set at whatever interest rate you lock into. Whether you go with a fixed versus a variable rate, that will all be dealt with and set at the time of signing for that term. And in that term, you're going to have many different components that were set up with your mortgage broker or the bank rep, and they include things such as your interest rate, prepayment privileges, and how your penalty is going to be calculated. Now, a term can be anywhere from 6 months to 10 years. Now, a 5-year term is the most common term that people go with. However, that's not saying that it should be the term that you go with. Whoever you're working with, whether it's a mortgage broker or a bank rep, you should be asking them what the best term is for you. Now, moving on to loan to value. An easy way to understand what loan to value means is it's a way to compare your mortgage loan amount to the value of your home. So for example, if you're purchasing a home with 20% down, that means you're borrowing 80% of the value of the home, which means that your loan to value ratio is 80%. And the LTV, loan to value, is something lenders always look at, and it's one of the deciding factors on whether you're going to be paying mortgage insurance or whether you're going to be getting a certain interest rate. And one important thing to note with LTV is anything above 80% means that you're going to require mortgage insurance. Okay, so now you're asking, Tom, what is mortgage insurance? Mortgage insurance is required anytime you put less than 20% down on a purchase. And mortgage insurance is a requirement by the lender because anytime you're putting less than 20% down, it's more of a risk to that lender, because if you were to default on your mortgage payments, then they need to sell that house. And if there's less money tied up in that house, then they may not get all their money back when it comes to selling the house. So let's say there is someone that is defaulting on their mortgage and they have to give up that property. The lender wants to make sure that they can sell that property, so they have that mortgage insurance in place in case that were to ever arise. But all of that is just small details that doesn't really impact you as the borrower. What you need to know is anytime you put less than 20% down on a property, you're going to be required to pay a premium. So this premium fluctuates as you put more money down for the down payment. So let's use an example of $500,000 for a purchase price. that mortgage insurance premium rate starts at 4% of that purchase price, and it goes down to 2.80% as you get closer to the 20% mark. So the premium paid from 5% versus the 15% goes from $19,000 down to $11,900. Now it's important to note that this premium isn't something that you have to pay out of pocket right up front. It's actually added to your mortgage amount. Now this mortgage insurance premium sounds like it's probably a bad idea, but in my opinion, if you only have 5% down versus 20%, it's better to get into the market today with that 5% versus waiting for that 20% down payment. Now, I don't want to go into too much detail regarding this. I have gone over it in a prior video. So let's move on to fixed versus variable rate. Now, a fixed rate is a set rate fixed for the entire term that you sign for. The fixed rate does not fluctuate during the entirety of that term. A variable rate is a rate that fluctuates as the Bank of Canada prime rate fluctuates throughout the year. The Bank of Canada prime rate is what determines your variable rate. So quarterly throughout the year, the Bank of Canada gets together and they determine what the benchmark rate is going to be. So today, recording this video, currently the benchmark rate is set at 2.45%. So typically when you're locking into a variable rate, you'll be locking into a set discount on that variable rate. So for example, if the lender is offering a prime minus 1.0%, that means your interest rate today will be 1.45%. Now it's important to note that the discount that the lender offers you and that you sign for that term does not fluctuate at all. Now what fluctuates is the Bank of Canada benchmark rate. So that benchmark rate set today at 2.45%. Let's say the Bank of Canada gets together next quarter and they determine that the benchmark rate is going to rise 0.25%. That means it's going to be going up to 2.7%, which means your interest rate right now is going to go up 0.25% as well. With the variable rate, a lot of lenders will actually let you lock into a fixed rate during that term as well. So if you think that there's a big rise in interest rates coming in the next year, well, you can lock into whatever the current fixed rate that lender is offering at the time. Now, lots of people do shy away from a variable rate. There are a lot of important factors when it comes to choosing variable versus fixed. One of the most important factors to consider is the penalty. A mortgage penalty is simply a penalty that is issued to you if you ever break your mortgage prior to the renewal date. So let's say your renewal date is coming up in 2 years from now, which is the end of your term. Well, if you break your mortgage today, you're most likely going to be incurring a mortgage penalty. Now that penalty is determined by what you signed at the start of your term. So if you went with the fixed rate, your penalty is most likely going to be significantly higher versus a variable rate. Now I'll leave it at that. I don't want to go into too much detail regarding the mortgage penalties because I do have another video going into this in more detail. Principal versus interest. The principal is simply the amount that you're paying towards your mortgage, and the interest is simply the cost of borrowing. Now, the interest rate was originally set and determined when you signed the term of the mortgage. So that 2.34%, whatever you signed up for at the beginning of your term, is the amount of interest you're paying on the mortgage loan. Let's say you had an interest rate of 2.5%. That 2.5% is the cost of borrowing on the mortgage loan amount. Equity. To put it in its simplest form, equity is the amount of home that you own. The more principal you pay down, the more equity you build up in your home. So let's say your home is worth $500,000 and your mortgage amount today is $400,000. That means you have $100,000 in equity. Open versus closed mortgage. An open term mortgage means that you can pay off your mortgage at any time you want. You're not going to incur a prepayment penalty, which is the benefit of an open term mortgage. However, your interest rate is going to be significantly higher. You typically won't be going with an open term mortgage because those interest rates are very high. They're more so suited for investors who are looking for a shorter term where they're flipping a house or they're doing another investment strategy where they're not holding on to that house for a very long time. Now with the closed mortgage, like I mentioned, you're not able to pay off the mortgage whenever you want. You are limited to how much you can prepay that mortgage. That's why it's important to consult a professional who knows the differences of lenders, where some lenders will have a lower prepayment amount versus the other lender having a higher prepayment amount. you always want to have options when it comes to paying down your mortgage as fast as possible. So that's everything you need to know when it comes to the basics of a mortgage. Now that is all the basics you need to know. However, there's a lot more strategies and components to a mortgage that need to be explained to the consumer and the borrower. That's why it's important to consult a professional when it comes to getting a mortgage. So I hope this video helped, and I'll see you guys on the next one.